Hello, investors. Today, we're examining BHP Group, the resource giant that's mining the commodities of tomorrow. With their hands in iron ore, copper, coal, nickel, and the emerging potash sector, BHP is more than just another company on the NYSE. With operations spanning over 90 locations, BHP Group is a formidable presence in the resources industry, boasting a market cap of $144 billion and a PE ratio of 18, trading around $55. This puts them at the mid-range of their 5-year share price spectrum. Their growth is strategically aligned with megatrends. Renewable energy, electric vehicle batteries, infrastructure, and sustainable farming are their playfields, with each commodity serving a piece of the future's puzzle. Let's talk profitability. Iron ore is their star, delivering an impressive EBITDA margin of 69%, followed by copper at 46%. While nickel and coal have seen a dip, BHP's diverse portfolio cushions any single commodity's downturn. Their Jansen potash projects are set to complete by 2026 and 2028, heralding increased capacity in potash production. Meanwhile, iron ore and copper expansion projects are underway in Australia and Chile, signaling continued growth. 2023 saw a profit of $12 billion on revenues of $53 billion, a decrease from the previous year's iron ore price surge. Their debt has also risen to $11 billion due to acquisition of Ounce Minerals and growth capex on the Jansen projects. Now looking at the trends in prices of their commodities, the iron ore prices rose during the last quarter of 2023 but has fallen in the first quarter to 2023 levels. This is still reasonable, but we need to understand why they are falling. China is the major destination for iron ore, and the falling iron ore prices reflect slowing Chinese economy. BHP Group share price is very sensitive to iron ore prices as this is their largest source of revenue with the highest margins. Copper prices are rising in the first quarter due to closure of First Quantum Mine in Panama and also reduction in Chinese smelter capacity. This might be temporary, and copper supply-demand dynamics suggest that until 2026 we may have surplus of copper. Coal prices have also fallen from 2022 levels. The 2022 spike in prices was due to the war in Ukraine, which caused prices to spike, and prices are returning back to pre-war levels. We can expect more of the same in 2024. Potash prices have also shown significant falls during 2023. They again spiked in 2022 after the start of war, as both Russia and Ukraine were exporters of potash. They are now returning back to normal levels. Considering the decision to diversity into potash was based on higher prices, we expect profit margins to be in the low single figures when Jansen becomes operational. Again, nickel prices have fallen quite dramatically following the spike in 2022. As lithium batteries have moved to ion batteries instead of nickel, there may be less nickel needed for batteries. BHP acquired Ounce Minerals for their nickel and bought them at the peak of the cycle. Currently, nickel operations are negative free cash flowing. This is a poor acquisition in our view. BHP state that there are opportunities in expanding copper production from the copper assets of Ounce Minerals. The nickel operations are being reviewed and may be stopped at some point in the future. Looking at the pros for the company, it is a diversified company with good cash flow and reasonable debt, and their dividend is good and they should be able to continue paying the dividend. BHP are planning capex of around $10 billion each year for the next 6 years to expand production of iron ore, copper and potash. This is a risk if we have significant Chinese slowdown, as they are the main consumer. Also, potash prices have fallen, and together with increased production of potash from the Jansen projects, there is potential for potash prices to fall even further. They also acquired Ounce Minerals at the top of the cycle, and the Samanda mine, which will come online from 2026 onwards, will mean China has option to source iron ore from Guinea rather than Australia. So the Muffy take is that although BHP Group is a good commodity stock with great cash flow, the falling commodity prices is a risk. This is reflected in the BHP share price falling from $67 to $55.67. We advise that we keep the stock on our watch list, and if and when the outlook for Chinese growth becomes clearer, we buy the stock. The other option is to sell put options. The chart shows the put option prices for January 2026. Selling the put option obligates the put seller to buy the stock at the strike price for which the put seller collects the premium. The January 2026 $52.50 strike put is selling for $5.77. If we sell this then, if we get assigned the stock, our net entry will be 48. This gives us a margin of safety. Again, this is not investment advice, it just illustrates our investment strategy. The analysis is based on Muffy's view on the stock and not a recommendation to buy the stock.